D-Day, the longest day, represents the turning point of World War II. It marked the initial invasion of the Allied forces of Western Europe and the eventual defeat of Germany. The Allied forces suffered over 10,000 casualties in the invasion, along with 1,557 Americans missing in action. In honor of the 70th anniversary, this June 6th, SD Bullion is proud to announce the launch of D-Day, the first coin of the Heroes SD War Collection in limited mintage. Heroes, don't let them die in vain. Start your Heroes SD War Collection June 6th, only at sdbullion.com. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us again today is one of our favorite guest hosts of the show out of the UK, Alasdair Macleod. It's great to have you back.
It's nice to be back, Eric.
And I'll add that it's nice to have you back on a week that we've had a big move to the upside in gold and silver, Alasdair. It's been a while since we've had some excitement to the upside.
Yeah, not used to it.
Well, we had the FOMC statement on Wednesday. I think everybody, myself included, was just sitting on the edge of their seat waiting for the inevitable smash down after the release. Usually 95% of the time over the last 5 to 10 years, in the afternoon on the FOMC days, the metals are smashed, and then again, really it continues throughout into early Thursday before it's allowed to reverse a little bit. We had Janet Yellen came out. They announced an additional $10 billion a month taper beginning in July, but the metals failed to budge, and shortly after that began to climb. And then on Thursday, we saw the big rally, over 4% in silver. Silver was up over $1 on the day. And then here on Friday, just touched 21 before consolidating throughout this afternoon. Looks like we're going to close above 2080. And then also in gold, the big move through resistance at 1,300. Knocked on the door a couple of times, and then once it cleared, 1,300 shot higher. It was actually traded above 1,320 for a little while, and it looks like it's going to close the week right around 1,315. So what's your take, Alasdair, on the action in the metals this week, especially in silver? In my view, it certainly looks like the downtrend, if you look at a 5-year chart on silver, the downtrend has been broken to the upside, and it looks like we could be seeing the start of the next move.
Yes, that's rather my view as well. The setup I found very interesting because there were huge short positions. In fact, 2 weeks ago, the number of managed money shorts were the highest they've ever had in silver by quite a large margin. In other words, everyone was betting on silver breaking down through the 19 and then going through presumably 18 or whatever their target was. Now, we also know that in gold at the same time that various of the big houses were saying that gold is in a bear market, and I think one in particular was talking it down certainly to 1050. I think that was the one who said it was a slam dunk sell 6 months ago. The result, I think, is that the hedge fund community was sort of convinced that there was money to be made on the short tack here. And now, actually, what happened was that the gold price, instead of even challenging the $1,200 level on the downside, it only got down to about $1,240. So what we have is a record oversold position and a gold and silver price well above the lows. Now, this to me is indicative of huge underlying strength. And I was very interested to see that yesterday's open interest on that big jump in gold and in silver, yesterday's open interest took off. So really what we saw wasn't so much bears closing, though undoubtedly bears have been closing, but there's been some genuine buying in there. And that is, I think, what's likely to squeeze the bears very, very hard, not just yesterday, but into next week. And it just looks to me as if this has now turned the corner. And because of the bear positions in the market and people having to do a double take, I think this could turn around very, very quickly, particularly if other events, such as the Iraq situation, deteriorates. And I also noticed that the Ukrainian situation is still bubbling along. It's just gone out of the headlines, but Russian tanks have been going into eastern Ukraine, allegedly. that is, I think, quite a flashpoint still.
You've been predicting a big move perhaps as soon as this summer, Eric. In your opinion, is this the start of a big move for both gold and silver?
Yes, I see that in the intermediate term. However, I think that early next week we're going to see a small correction. Maybe 50, 75 cents or so on silver, 20, 30 bucks on gold at the most, or something like that. And the highest probability day for that to show up will be Tuesday in the London trading hours going into the COMEX Open. Typically, that's when we see the highest probability of action by the cartel, in part because of the cutoff date for caught reporting data and just patterns that follow through with what we have now seen is almost 2 weeks consistent of buying straight up, and yesterday's big move and all that good stuff. I mean, the momentum to the upside has been pretty strong, and it most likely will, in the eyes of typical momentum traders, they're going to be looking at over their shoulder for possible consolidation after a big run like that. That's just typical psychology in markets, and the cartel is well aware of that, and they use those points to attack, to manage in their managed retreat mode, as we've described many, many, many times. So that's probably what will happen sometime early next week.
And I would add, from a market's or a trader's perspective, that certainly it wouldn't be unexpected to have silver retest the $20 level and gold retest $1,300 after such a big move through that. And with $20 being such a critical level for silver that has been resistance, certainly would not be surprising in any means to have that now tested as support and have it trade back down to that. But personally, I would be surprised if silver breaks back down below 20 at this point.
Yeah, other than for a period of a couple of minutes, quite literally. Right. Tuesday morning COMEX Open, we can maybe hit 1975 or something like that, but it's going to be an intraday phenomenon. And then throughout the latter part of next week, going into the week thereafter, I think we're going to continue to move higher in July and beyond, and just basically avoid the pattern of the quote-unquote summer doldrums because of what we've seen going back all the way to last April. The amount of suppression has been monumental, and we even saw a repeat of that over the last couple of months, putting a kibosh on the earlier rally this year that we saw. And the bottom line, relative to all of this, is that the demand coming out of Asia and the Middle East is monumental still. And despite the downplaying of that demand, it is a backstop, and it was part of the reason why in early June, when everyone was fearful of gold breaking down much further below the 1,200 level and silver falling through 18, people speculating 15 was on the horizon and all that, and I called that the market would turn the following week, and I think it was 3 weeks ago when we were having our show, and the trading patterns belie that. And if you look now, this week, you see slight weakness in the mining shares and the price action leveling off, so that's partly why I think that next week we'll see an early correction, but then prices are going to move higher because the fundamentals support it.
Now, Alasdair, I'd like to shift gears slightly here, talk about a story I know that you just spoke with the Wall Street Journal regarding. We're coming up here in a couple of months on the end of the silver fix in London. There's been a lot of questions that have been raised about whether it'll also mark the end of the gold fix. And a lot of the international associations and agencies have been scrambling, trying to come up with a replacement for the London benchmarks in the silver industry. I thought it was interesting here this morning, or I guess it was yesterday morning, article Bloomberg released that stated that they're looking at new fixing system for the $5 trillion silver market and the $18 trillion gold industry. And I just thought that was interesting, as we know on a physical side, there isn't anywhere near $5 trillion in silver that changes hands in any given year, as well as the ratio of a little over 3 to 1 of gold to silver. I think the quote they had here was sourced from the CPM group, and they said about $5 trillion of silver and $18 trillion of gold circulated globally last year, according to the CPM group. So obviously, if that is the case, they're talking about derivatives in gold and silver, and those statistics are rather interesting. But back on topic here from that tangent a little bit, Alasdair, what's your thoughts on the end of the silver fix, and then any potential implications on the gold fix?
Well, this story really started with Deutsche Bank being investigated by the German banking regulator called BaFin. And very shortly after that investigation started, Deutsche Bank threw in the towel on both the silver fix and the gold fix. The gold fix they tried to sell, but they just withdrew from the silver fix because there were no buyers for their seat. They tried to sell their gold fix seat, but again, there were no buyers there. Now, that tells me something very important. It tells me that the lawyers and the compliance officers in the bullion banks actually think that this is so conflicted that it's not something they should really get involved with. And I think that has really led to the end of the silver fix, and the last fix is going to be, I think it's on the 14th of August this year. Today there was a meeting hosted by the LBMA with interested parties. I understand about 100 people turned up, and there was a wide-ranging discussion as to, how to take this forward, maybe get someone else involved with the fix, or someone set up a platform, or I don't know, whatever. So lots of ideas were kicked about, but nothing concrete came out of it. Now, I think that the fact that no other bullion bank is willing to jump into a situation which is really quite profitable for it does tell me that the regulators are looking at this very, very closely, not just BaFin, but I think also the Financial Conduct Authority in London. And I think that while investigations about, the fixes in the foreign exchange markets and gold and LIBOR and all the rest of it, these banks are all sort of trying to just not get involved, because get involved leads to fines, and you don't want to get involved. So I actually think that the silver fix is dead, and I think that the changing scene that we have is going to lead to the demise of the gold fix as well. The effect on the market, the one thing I would say about this fixing arrangement, because the fixing members are dealing for themselves and also they have customer orders, the temptation to game the system is enormous. And you will probably know that Barclays were fined quite a large sum of money for being found guilty of doing just that. If I was a bullion bank, I just wouldn't want to get involved. Just stay away from it. So I think this fixing business is over, and we're just back to a market. I mean, there's no reason why the market just can't continue to make a price the whole day long, 24 hours a day. And if you complain about, sort of liquidity and all the rest of it, then, the fix, I think, is a distortion. I think the liquidity in the market should actually be natural. And the other point about the fix is that it does have the effect of either delaying business or bringing business forward, which would otherwise occur in the market. So I think the market's just got to rearrange itself, and I think it would probably be better for it without the fix at the end of the day.
We can add a footnote to that as well, too. There's still, to this very day, speculation that the fix dying is a telltale sign that the cartel is losing its grip. And though it definitely is indication of a light being shined in the kitchen and cockroach scurrying, the vast majority of manipulation and tools that the cartel uses are far more powerful than the fix itself. So people really should just drop that speculation. The bottom line is that most likely normal markets are going to, the end-of-day pricing is going to determine what the fix does right now. And that's where we will likely be both with gold and silver. And ultimately it won't have a huge impact on the cartel's ability to move prices around, because their bigger tools are dumping of paper contracts, moving of leased gold out of allocated and non-allocated vaults and so forth. So that's really something that people need to hear again, because there's still, to this day, speculation about the fix actually being a sign that the cartel's dying, and it just shows that they're having trouble concealing some of the things that they do that are not legal. But that's a pretty good segue to talking about another big story that's out in the market today, or this week, I should say, regarding the Bank of England's allocated holdings and a reduction of 755 metric tons, presumably for holding of central banks. Maybe Russia is pulling some of its gold out. I mean, various advisors and Putin himself has said that they are gravely concerned about the safety of gold holdings at central bank storage relations, and that's probably one of the considerations behind they're pulling what seems to be some of their gold out of the Bank of England. So, Alasdair, you had discovered a story earlier, actually it was late last year, about the Bank of England's virtual tour on their website, and it showed a discrepancy compared to their annual reporting in 2013 about their gold holdings. I wonder if you can address this latest story about the 755 metric tons moving out of the Bank of England.
Yes, certainly. The story last year was there was a discrepancy of up to 1,300 tons. And basically, on the virtual tour on the website, they were reporting 100,000 bars less. These are 400-ounce bars less. That, given that you're talking about over 400,000 as opposed to over 500,000, the discrepancy was up to 1,300 tons. It could have been somewhat less than that. As it turns out, the year-end storage, custody storage, which was reported earlier this week, turns out to be 755 tons less than the figure at the end of last year. Now, this doesn't necessarily represent buying and selling in the market only. I mean, obviously, buying and selling is a very large part of it. But it will also reflect gold that is moved into storage and gold that is moved out of storage without any transactions happening. For example, Venezuela, was it 2 years ago, took gold out of the Bank of England. There was no transaction involved in that at all. Equally, I wouldn't be surprised if one of the weaker Eurozone members might have moved gold into London with a view to selling it at some stage in the future. So, I think one can be tempted to read too much into this figure. But the reason the 1,300 tons, or up to 1,300 tons, was very important last year was that this happened during the smackdown last April. Because if you remember, the story went round the market that there's going to be a big bear raid in gold. And sure enough, there was a big bear raid in gold, and so everybody who'd been tipped off went in and helped the process down. Surprise, surprise, those pesky Asians went and decided to buy gold very, very cheaply. And to keep this coordinated smackdown in place, what had to happen was the central banks had to supply monetary gold in order to satisfy that demand. Otherwise, the price would have risen. I think that was really the importance of that 1,300-ton figure. But of course, since then, things have settled down a bit. Maybe there certainly has been large flows of gold going on into the Far East. The beginning of this year the flows were exceptionally heavy. It's quietened down recently. And talking to our refiners at Gold Money, the message I get is very clear. They're still scrabbling for stock. There just isn't enough bullion around to satisfy demand. So the situation is still very, very tight, and you can sort of see this from time to time with the London gold forward rates going negative. At the moment, they've gone positive again, which suggests there has been a little bit of supply into the market. But broadly, I mean, what little supply there is just gets taken out, and then goes negative again. So I think I would summarize and say that it doesn't surprise me that 755 tons less is reported this time, but I think it would be a mistake to read too much into it. What's far more important is the overall supply and demand situation for physical.
You just mentioned the Gold Money's contacts with the refiners, and the intelligence that you see is that they're still having trouble sourcing metal. Earlier, and for quite some time, for many, many months actually, it was reported that the refiners were running 24/7 and that they were running 3 shifts, and that every refiner in Switzerland was in that mode. Is that still the same story that you're hearing as well from Gold Money context?
Yeah, I haven't asked that specific question again, but I believe that it is still the case. And I mean, it's interesting. Various other people in the industry are seeing that, all this business for refining, and I think it's Colotti in Dubai are spending something like $60-70 million on expanding their refining capacity.
For over the ability for over 1,000 metric tons per year in that new refinery they're building. It's huge.
That's right. I heard it was the capacity was going to be 1,400 tons. I mean, that is about twice the size of any of the individual Swiss refiners. So there is huge capacity out there. One of the other things that's happening in the Middle East is that the Arabs are recasting their bars from the London standard into the new Chinese 4 nines 1 kilo bar standard. And again, I've got that from our refiners. And that I find interesting because I think the Arabs are sort of seeing that actually their market for gold, their world is becoming increasingly Asian, with China, Russia, and so on and so forth, and India, of course. And it sort of rather indicates that they see the West in the form of Europe, the London market, and the US as being declining in importance when it comes to gold.
And I want to just ask you, Alasdair, your thoughts on the CPM Group's Jeffrey Christian stated in an interview with, I believe it was Kitco this week. He claimed that the demand for gold in Switzerland was vastly higher than the demand for gold in China. And I thought that was rather interesting with
one in the same.
Right, that the demand for the gold in Switzerland is not staying in Switzerland. It's not what happens in Vegas stays in Vegas. The gold is not partying in Switzerland and remaining in Switzerland. And as soon as it's refined and turned into kilo bars, it's out the door.
Well, yeah. I mean, we know that there's an awful lot being exported from Switzerland to China. That we do know. We know that really from two sources, the import-export figures from Hong Kong and also Switzerland's own import and export figures. But I think that there are two elements to this. There's gold which is actually imported into Switzerland and refined and taken out. There is also gold that goes into Switzerland but remains, if you like, in the free trade zone so that it doesn't end up being recorded as imported. Now, I didn't hear what Jeffrey Christensen said, but it could be that he's referring to that split. And what this means is that the imported figures into Switzerland actually understate the true case. So I think it is quite likely that there is a certain amount of stockpiling going on in Switzerland, which is outside Switzerland in the sense that it is in a free trade zone.
But it most likely wouldn't be Chinese nationals or the central government of China.
Well, it could be anyone. It could be anyone, Eric, because I think most of us sort of have suspicions about our government's intentions, and we view Switzerland as actually being a pretty safe place to store our gold. So, I mean, it can be anyone from the Middle East to to the US, to the UK, to Russia, China, wealthy Indians. I mean, we've got some very wealthy diasporas living outside China and Southeast Asia, and the Indian community in Europe is I mean, particularly London, is extremely wealthy now. So you can see that these people who have a natural bent, if you like, towards gold are quite likely to accumulate it, and presumably accumulated in the safest place they can think of, and that very often is Switzerland.
Yeah, makes sense.
I wanted to segue here a little bit to give our listeners a quick update on the state of the retail market here in the U.S. We've heard a little bit of the state of the physical demand over in Europe from Alasdair. In silver, we saw a big return of demand the second half of this week, with price breaking back above 20 and rallying. But really over the last 2 weeks, for the whole U.S. retail market, the retail demand both in silver and gold has been slim to none. A lot of the large dealers and primary dealers are not seeing many sales. One of our contacts at one of the authorized purchasers from the U.S. Mint did not even place an order this week, which is the first time in recent memory that I can remember that from any of the authorized purchasers of the U.S. Mint. But again, we're speaking of strictly U.S. retail coin demand and not looking at any of the other global phenomenon and demand from the East, as well as industry demand here in the U.S. But we remain at historically high levels, just tapered off a bit from the last year or two's record sales paces. But I don't think it'll be long if the rally continues here that we will see the sustained retail sales pick up as we saw here the second half of this week, with the markets finally seeing some action, some excitement here.
Can I interject on that? I find what you say interesting, and it rhymes slightly with the drop-off in Chinese demand. Public demand in China has slowed down quite a bit from earlier this year. Now, you could argue that it was just so much demand in the first months of this year that it was bound to slow down. Undoubtedly, that's true. But I think there is this sort of public view that, if gold isn't going anywhere, then there's a little bit of disappointment, perhaps, amongst some of the bulls. I think on the margins you do get that. But if we are right in our belief that this market has now begun to turn the corner and very soon the trend will be up, then that's going to turn around very quickly. And it's going to turn around against a background of very little stock in the market. And I think that could actually push prices up quite a lot higher. So I don't actually worry too much about the lack of demand at the retail level. I think it is perfectly consistent with the markets we've had. And I think it is actually quite remarkable how well it has held up, given the length of time that gold and silver have taken a bad battering.
Yeah, and the level of short interest, too, in silver in particular, is also going to be another backstop, because there's always going to be that recovering of the shorts trade going on over the course of this entire summer.
Yeah.
Yeah, and I definitely agree with that, Alasdair. When you've had, let's take silver, for example, when it's down well over 50% off its 2011 highs, and then after that you have a 12 to 18 month consolidation where you really haven't seen much action. Trading from 18 to 21, but in a pretty tight zone. There's really not a lot of excitement at the retail level. And when you combine that with the discouragement that, like you said, the higher prices people have been expecting have not yet materialized, that a lot of that demand is pushed off for a little bit until they start to see some of that promise of the move to come, at least that we're expecting.
Yes, and then there will be lots and lots of people saying, oh, damn, I wish I'd bought it. I knew it was right to do it, and I've missed it.
Exactly. That's how it always works.
It does. It's funny. We all know that what we should do is buy low and sell high. But actually, we end up selling low and buying high, don't we?
Yeah, when you think about normal retail products, anything going on sale, people flock to the sale and buy. When it comes to financial assets, things are falling.
The other way around.
They're to death, and they don't want to touch it.
My piece of advice is always to think about your grandmother and what she would do if she's pushing her little cart on at the store and she sees a 25% off sale. She doesn't stop and think like, well, maybe I should come back and get that bag of potatoes next week. It might be 30% off. She throws two in her cart and keeps moving.
Yeah, I wrote an article about this actually, I think a bit over a month ago, really comparing the sort of the trend followers, the technical analysts, with the people who really go and try and work out what the true value of something is. And the obvious comparison with the chartists is, of course, Warren Buffett. I'm not talking gold now, I'm just talking generally. Now, Warren Buffett has become immensely rich, basically by recognizing value and going out and buying it without regard to what the prevailing fashion in the market is. He's got his metrics, he knows how to value things, and he goes and buys it. And now I see people like Warren Buffett being immensely rich. I see most chartists perhaps making a reasonable living, but not being immensely rich. I think that's a lesson for us all.
Yeah, and in the precious metal space, the cartel, being who they are, recognize the signals that are sent off by technical traders, and they use them to their advantage. So more often than not, you can get some technical analysis facilitating profitable trades in the equities market, but when you turn to precious metals, everything flips on its head, and people who use standard metrics and standard tools in technical analysis usually fall down because they're not aware of the other dynamics that are going on in the market.
And do you know the thing which is so ridiculous about this? If, let us say, you think, right, I'm going to go into the market and I'm going to buy gold. So you go along to your broker and you place an order and you buy a few COMEX contracts. At the same time, you tell them at what price you're going to sell it. I mean, come on. If this goes down 3%, I'm going to sell it. So what happens? I mean, you get all these people, the market makers or the bullion banks, the people who are running the show, they know where all the stops are. And the easiest way to make money is just take them out. So, I mean, it really is like taking candy off a kid.
A lot of speculation recently about the hypothecation and rehypothecation of warehouse receipts for the base metals in China, and the concern that this is another example of their shadow banking system creaking along and coming under pressure. And I reflect back on, I believe it was back in February of this year, that there was a lot of concern about trust products related to aluminum companies and other base metal companies that would take their business prospects and roll it up and raise funds in a trust product, and then investors would be exposed to the ongoing risk associated with the business operation of these base metal companies. And recently, in that point in time, there was one trust in particular that had gone insolvent, and I believe it was covered by the tune of 400 and some 16 or 19 million dollars as a backstop by the Chinese central bank, because they just did not want to see their shadow banking system have a domino impact in a deflationary type of situation that would get out of their control. And I think to some extent this latest scare and news coverage, and in particular not 1 week goes by where Zero Hedge is banging a drum that seems to be primarily Goldman Sachs and other interests speaking about this whole risk factor. And I'm just wondering if you can address this. And I know that your perspective, based on other interviews I've heard you speak about this subject, that you're skeptical about the risk factor of this exposure, and I'd agree with that. And back in February, our listeners would recall that I was downplaying the risk, that people were very nervous about this trust product exposure and a domino crash coming out of China, and it's very clear that China's willing to backstop against these type of pressures in the market.
Multiple rehypothecations are going on, and it's all going to end up in a disaster. Disaster for what? The copper price. I would say aluminium price. You say aluminum price.
Right.
But the first question that comes into my mind is: are these guys long or short? And I'm pretty sure that with that story, that Goldman's are short of copper, and I'm sure they're also short of aluminium. So, that taints it for me. What I couldn't understand in all this, they were saying that, when this gets exercised, people are going to sell copper. Now, hold on a minute. If you've got, let's say, 10 times as much copper is meant to be in the warehouse than is actually in the warehouse, then when it's discovered, then you've got to buy more copper. I think it's actually quite simple. So okay, there are timing issues and all the rest of it. But then it seems that, yes, this has been happening, but for it to happen, what they've had to do is to bribe people in the warehouses to actually give false receipts. Now, that's a slightly different thing. You end up with the same story at the end of the day. But, the whole sort of commentary on this seems to me to be really angled towards supporting my position. So I felt that right from the beginning. And I didn't think that this sort of thing was going on in gold and silver. And the reason for that was that there was some announcement from the government, or was it the People's Bank of China, who regulate gold and silver markets through the Shanghai Gold Exchange, that they were clamping down on this sort of, let's call it, imaginative use of gold and silver. And that was over a year ago. They obviously didn't clamp down on copper and aluminium and iron and all the rest of it. So, to my mind, the thing is a bit of a non sequitur. Apart from anything else, China, her demand for copper is likely to be up something like 10 to 12% this year. Why? Because she is re-electrifying the country. She's stringing huge, great copper cables all over the place to carry all the electricity, which they're going to need over the next 5 to 10 years. So the demand for the copper is there, and it must be very galling to the Goldman Sachs of this world to see copper refuse to go down below 300. so I look at this with a little bit of amusement, really, in a sense. But I think there's a whole load of vested interest in this, which, to my mind, means that you can't really sit there and analyze it.
Yeah, and this has all happened in the last 3 weeks in terms of the latest wave of concern about these warehouse receipts being super rehypothecated, and all the while, gold and silver have been catching a bid. So
yeah. You see, the other thing is, I sort of ask myself, how does Goldman Sachs know this sort of thing is going on? Because the way the deal was explained was actually, it looks very much like a normal trade finance deal. In other words,
right.
I'm shipping copper from, let's say, Chile. I get a bill of lading or whatever it is. It's going into the carrier, leaving Valparaiso. And it's being shipped. I need to pay for it as soon as it leaves the docks. So I go to a bank and I get a letter of credit. And letters of credit are central to trade finance. So how is it they seem to know that one letter of credit is genuine and another letter of credit isn't? And I just sort of think that the whole thing is really sort of pushing a vested interest. And I know I may be being unduly cynical, but having seen how these guys operate in the gold and silver market, nothing would surprise me. I mean, I tell you what, these markets have been fascinating, have they not? I mean, they really are. And yes, you can see the way the psychology is being built up at the bottom of a market, and you can see why it's all going to go absolutely pear-shaped for the bears. I mean, it's just such a lovely setup.
And everything else in the financial markets, and by extension beyond, in the geopolitics and economic reporting of statistics that are just nonsense and so forth, and the level of complacency that's out in the financial markets, it's kind of eerie. I mean, things seem calm on the surface to the vast majority of people worldwide that participate in financial markets, at least in the Western world. But
that's right.
I don't think I've ever seen it so under the surface contrary to that assessment. It's very, very eerie.
It is.
We're going to have a lot of fireworks later this year.
Well, I think so, and I mean, I sort of try to tot up where the ownership of all the above ground stocks of gold, and I've come to the conclusion that 3/4 of it is now in Asia.
Wow,
that's 3/4. Now, that's the Middle East and North Africa. North Africa isn't Asia, but it's the same sort of thing. Also, you've got the Southeast Asia. Remember that Southeast Asia, Japan, and South Korea accumulated gold back from sort of 80s onwards in quite large quantities. I mean, wherever they got rich, wherever people sort of suddenly became middle class, they started buying gold, and that was particularly true in on the Pacific Rim. Then you've got India. Of course, we all know about India, but I mean, remember that the Gold Control Act was rescinded in 1990. So we've had, 23, 24 years of Indians being allowed to buy gold. And it's not as if they were short of gold before then. And then now, so China's fairly recent. I mean, China, I think, has probably got a bit of catching up to do. So, you put it all together, you're looking, I think, at about 3/4 of the above ground stocks are probably in Asia, including the Middle East.
Yeah, and regardless of what the actual numbers are, this movement of gold has moved from weekends to strong, and it's not coming to the market anytime soon.
Absolutely. No, I quite agree. And I think China is fascinating in this because, she's been accumulating gold very cleverly. The other thing that's interesting is the way that she has encouraged her own citizens to acquire gold, which in theory makes it more difficult for the state to acquire gold. But the state's got control of the mines. She takes all that. Of that, I'm convinced, and I think I've got circumstantial evidence that that's the case. As well as that, I think that the state takes all the scrap gold, and the scrap gold in China is quite a figure because anything that's delivered out of the vaulting system into public hands and then subsequently sold is scrap gold. It's sold and it has to be resubmitted for refining. So I think there's, the Chinese government are routinely getting something like 600 to 700 tons of gold a year between mining and scrap. Of course, she also operates in other markets. And I don't know if you saw, but there was a report that about central banks and sovereign wealth funds, OMFIF, which, if I can remember what it stands for, it's the Official Monetary and Financial Institute Forum. This is a sort of central bank setup. They produced a paper which they publicized, I think, on Wednesday. In that paper, they said two things. Firstly, the investments in this lot totaled $29 trillion equivalent.
That's right.
A lot of this was in equities. You probably saw, you had probably picked up this report from elsewhere. But the other thing is that the SAFE, which is the state-administered foreign exchange fund, is taking stakes in companies. And I mean, these stakes won't be sort of directly in SAFE. I mean, they'll set up offshore companies. They'll hide their ownership. And they've been buying stakes in European companies and American companies. Now, it's quite clear to me that what they're doing is they're building up into a position so that, as Jim Rickard says, if there's a financial war, then they've actually got us all by the short hairs. They can easily destabilize the West a lot more effectively than they could possibly destabilize the West by, let's say, sending out a crack navy or whatever. So this is actually a very big geopolitical game that we're talking about when it comes to gold, the Western central banks are, they don't seem to understand it. I find it quite extraordinary.
I remember James Turk making the argument as much as 3 years ago that Chinese monies were flowing into positions in blue chip stocks in the United States under the 5% threshold, because that's the level where you'd have to report to the Securities and Exchange Commission of a large significant holding. And I suspect that that's still going on. What is the threshold in the London Stock Exchange for reporting? Is it also 5%? I don't know.
No, I think there's a 3% threshold where you've got to declare it. But this is a tricky one, because there are if you're unscrupulous, there are ways around it.
Sure.
And that's and so the idea that but you see, I mean, again, if China's got a lot of 5% stakes, I mean, all she does is she sells 500 stocks in one go, bang, and then what happens to your market? It falls apart.
Yeah.
So and that's even before she shorts it, even before she let's say sells futures and does things like that. I mean, there's a lot of potential for damage if China decided to go down that route. And I think she's doing it not because she intends to go down that route, but really to protect herself from retaliatory action from either the United States or Europe.
Yeah, there's definitely an ongoing leverage position that benefits them. There were even some indications that back in 2008 that they made calls to Paulson and other people in the United States' bureaucracy saying, hey, these mortgage-backed securities that we own, 800+ million of them, and your treasuries, but in particular the mortgage-backed securities, you need to do something about that to backstop it. And lo and behold, the United States Treasury announces that the government's going to, take over Fannie Mae and Freddie Mac, and that was back in July of 2008. And that was the exact point that $149+ oil and the peak of the commodity market hit, and then everything turned down, and Lehman Brothers came 2 months later or something like that, and there we were. The deflation crash began. But that was an example of China exerting exactly that same kind of political leverage, and they had their bets in mortgage holdings covered by the U.S. taxpayer.
Yes. Well, that was an interesting story, because we have a BBC journalist who interviewed Paulson. And you may indeed be referring to that, because what this guy did
before his report. I mean, that there were indications even as like a month after Lehman Brothers, it began to surface that this backdoor deal was done by Paulson.
Absolutely. But what fascinated me was this guy Robert Peston. In his blog, he said that when he interviewed Paulson, the bit that ended up on the cutting room floor was Paulson telling him that the Chinese had said to him that they'd been contacted by the Russians with a view to capitalizing from this situation. Like let's sell short sort of thing. Yeah. Let's take them down.
It's
and
like
I think
the
this
James
is
Rickard thesis. Russia came
absolutely.
saying, "Hey, shall we gang up on them now?"
No, I mean, I don't know whether this is true or not. I mean, it's quite possible that the Chinese invented the story to put pressure on Paulson. But I mean, having said that, I think Robert Peston, he will have been told that by Paulson. Of that, I have no doubt at all, because Peston, as a journalist, does have integrity. I see no reason why Paulson would tell this to Peston if it wasn't true. So, to my mind, I think this is actually, as you say, pretty good evidence that what Jim Rickards has been saying looks to be true.
Well, before we wrap the show up here, I know I think before the end of the year, I look for silver to make a run at least towards 26, where we really saw that waterfall decline back last year, and the big part of the correction in the last year take place. In gold, we'd be looking at a run somewhere towards 15 to 1600 is what I think at a minimum we'll see in 2014. How about you, Alasdair? What do you see in gold and silver over, say, the next 6 months, second half of 2014?
Well, I never make price forecasts because they always come back to bite me.
Very wise, very wise.
But what I do see is something on the lines of what you're talking about. I think that once this establishes itself in an uptrend, and I think it's a matter of a few weeks, perhaps, when that might occur, then I think the prices of both silver and gold are going to run very, very quickly. And if we look back on 2014 and saw that was the year when they broke into new high ground, it wouldn't surprise me. I'm not forecasting it. And I wouldn't be buying them on that basis. But I think if I look back on 2014 and I see that was the year where gold and silver really started storming through into new high ground, I would not be terribly surprised, because the underlying dynamics are there. And going back to the valuation point, if you value gold in $1934, the current price is around about $14. And we have a system which is in the early stages of complete collapse. So what's not to like?
All right, Alasdair, it's always a pleasure.
That's very much my pleasure. Thank you both.
All right, for the Doc and Eric Dubin, thanks for tuning in to SD Weekly's Metals and Markets with Alasdair Macleod.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.